Investment fees. Masterclass. The average American investor pays between 1.5 and 2.5% in total annual investment fees. That might sound small, but over a 30-year retirement, those fees can consume 30 to 50% of your potential wealth. Today, we're going to shine a light on every fee hidden in your investment portfolio, show you exactly how much they cost over time, and give you a clear action plan to reduce them without sacrificing quality or service. Let's start with the most visible fee, the expense ratio. Every mutual fund and ETF charges an expense ratio, expressed as a percentage of assets under management. This fee is deducted directly from the fund's returns, so you never see a bill. A fund with a 1% expense ratio and gross returns of 8% delivers only 7% to you. You might not notice the difference in any single year, but compounded over decades, it's enormous. Here's the math that will change how you think about fees forever. Consider two investors who each start with $500,000 at age 65 and earn gross returns of 8% annually. Investor A pays a total of 0.1% in fees through a low-cost index fund. Investor B pays 1.5% in total fees through actively managed funds plus an advisor. After 25 years at age 90, Investor A has approximately $3.29 million. Investor B has approximately $2.16 million. The difference, $1.13 million. That's how much 1.4% in extra annual fees cost, over $1 million on a $500,000 investment. And this is without any additional contributions. The expense ratio is just the beginning. There are multiple layers of fees that most investors never see. Let's break down all of them. First are trading costs within the fund. When fund managers buy and sell securities, they incur brokerage commissions, bid-ask spreads, and market impact costs. These aren't included in the expense ratio, but they reduce your returns. Actively managed funds with high turnover can add 0.5 to 1.5% in annual trading costs on top of the stated expense ratio. Index funds with low turnover have minimal trading costs, typically 0.01 to 0.05%. Second are 12b-1 fees, which are marketing and distribution fees charged by some mutual funds. These are included in the expense ratio but deserve special attention because they're paying for the fund's advertising, not for managing your money. Many funds charge 0.25% to 1% in 12b-1 fees. Low-cost index funds and institutional share classes typically have zero 12b-1 fees. Third are sales loads. Front-end loads are commissions charged when you buy a fund, typically 3 to 5.75%. If you invest $100,000 in a fund with a 5% front-end load, only $95,000 actually gets invested. Back-end loads, also called contingent deferred sales charges, are charged when you sell. These typically decrease over time, starting at 5 to 6% in year one and declining to 0 after 5 to 7 years. No-load funds have become the standard for informed investors, and there is no evidence that load funds outperform no-load funds. Fourth are advisory fees. If you work with a financial advisor, they typically charge 0.5 to 1.5% of your assets under management annually. On a $1 million portfolio, that's $5,000 to $15,000 per year. Some advisors charge flat fees or hourly rates instead, which can be more economical for larger portfolios. Advisory fees aren't inherently bad. A good advisor provides tax planning, retirement income strategy, estate planning coordination, behavioral coaching, and financial planning that can more than justify their fee. The problem arises when you're paying advisory fees on top of high fund expense ratios, creating a fee stack that can exceed 2% annually. Fifth are wrap fees or platform fees. Many advisory platforms charge an additional fee on top of the advisor's fee for access to their investment platform, reporting tools, and custodial services. These can add 0.1 to 0.5% to your total cost. Sixth are cash drag. Many investment accounts hold a small percentage of assets in cash or money market funds that earn less than the overall portfolio. While this isn't technically a fee, it reduces your effective return. A portfolio holding 3% in cash, earning 2% while the rest earns 8%, has an effective drag of 0.18% annually. Let me show you what a typical fee stack looks like for 3 different investor profiles. The high-cost investor uses actively managed funds with a 1% average expense ratio, pays a financial advisor 1%, has trading costs of 0.5%, and has 0.25% in other fees. Total all-in cost, 2.75% per year. The moderate cost investor uses a mix of index and active funds, with a 0.4% average expense ratio. Pays a financial advisor 0.75%, has minimal trading costs of 0.1%, and has 0.1% in other fees. Total, 1.35% per year. The low-cost investor uses index funds with a 0.05% average expense ratio, uses a flat fee advisor or self-manages, has near zero trading costs, and has near zero other fees. Total, 0.05 to 0.3% per year. On a $1 million portfolio over 25 years with 8% gross returns, the high-cost investor accumulates approximately $3.27 million. The moderate cost investor accumulates approximately $4.65 million. The low-cost investor accumulates approximately $6.45 million. The difference between high cost and low cost is $318 million, more than 3 times the original investment. Now let me be balanced about this. Fees aren't everything. A bad investment strategy with low fees can still underperform a good strategy with moderate fees. An advisor who prevents you from panic selling during a crash is worth every penny of their fee. Tax loss harvesting, Roth conversion optimization, and Social Security timing advice can add significant value that exceeds the advisory fee. The key question isn't whether to pay any fees, but whether the fees you're paying are delivering commensurate value. Here's a framework for evaluating fee value. If your advisor provides comprehensive financial planning, including tax strategy, retirement income planning, estate coordination, and behavioral coaching, a fee of 0.5 to 1% can be justified. If your advisor simply selects funds and rebalances, that can be accomplished with a robo-advisor for 0.25% or less. If you're paying high expense ratios for active management, the data is clear. Approximately 90% of actively managed funds underperform their benchmark index over a 15-year period after fees. Let me walk you through the most impactful fee reductions you can make. First, switch to low-cost index funds. The average equity index fund expense ratio is about 0.06% compared to 0.66% for actively managed equity funds. On a $1 million portfolio, that switch alone saves $6,000 per year. Second, negotiate your advisory fee. Many advisors are willing to reduce their fee for larger accounts or long-term clients. A reduction from 1% to 0.75% on a $1 million portfolio saves $2,500 per year. Consider flat fee or hourly advisors if your portfolio is over $1 million, as the percentage fee becomes very expensive in absolute dollars. Third, eliminate redundant fees. If you have both an advisor and a fund of funds or target date fund, you're likely paying 2 layers of management fees. Choose one or the other. Fourth, use tax-advantaged accounts efficiently. Hold tax-inefficient investments like bonds and tax-deferred accounts, and tax-efficient investments like index funds and taxable accounts. This isn't a fee reduction per se, but it reduces the tax drag that functions like an additional fee. Here's your action plan. Step 1, inventory every fee you're currently paying, including fund expense ratios, advisory fees, trading costs, and platform fees. Step 2, calculate your total all-in cost as a percentage of assets. Step 3, evaluate whether each fee is delivering value that justifies its cost. Step 4, switch high-cost funds to equivalent low-cost index funds or ETFs. Step 5, discuss fee reduction with your advisor if their services justify the cost or consider alternatives. Step 6, recalculate annually and document the savings. Remember, every dollar saved in fees is a dollar that stays in your portfolio and compounds for your benefit. The fee difference between a high-cost and low-cost portfolio can easily exceed the total amount most people save in a lifetime. This is one area where a small change in percentage points translates to a massive change in outcomes. Take the time to understand and optimize your fees, and your future self will thank you.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.